We've got a lot to cover today. So, here are the topics we're going to cover. As is obvious from the title, we are talking about the Inflation Reduction Act, which passed just over a year ago. We're not going to spend a lot of time today on, kind of the background or some of the more nitty-gritty pieces of the legislation. We did that last year, so please feel free to check out last year's CLE. There's also a resources page on the V&E website that has lots of good information and client alerts and other decks and resources for you, as well as all of our contact information. We've extended the presentation today by 15 minutes, so we're going to be going for an hour and 15. Following the release of the labor regs a few weeks ago, we figured that was warranted. But not to worry, we are scheduling a follow-up session that will just do a deep dive into those labor regs, so keep an eye out for that. So the few things we're going to talk about today are credit monetization. We're going to get into some bonus credits, domestic content and energy community, labor regulations as mentioned. We're going to hit some of the other various credits in 45 and 48. We're going to talk a little bit about RNG and then give an environmental law update. Next slide. So I'm joined today by some esteemed colleagues. Corinne Snow is a counsel in our Environmental and Natural Resources group located in New York. Alex Bluebond is a counsel in our labor and employment team. We are so grateful for all the work he's done diving in on the labor requirements in the IRA. He's really our secret weapon when it comes to those. We have Heather Barron. She's a counsel in our tax group, also located in New York. She joined us recently this year to help round out our IRA and tax practice. Also very happy to have her. I'm Lauren Collins. I'm a partner in the tax group located on the West Coast. And lastly, joined by my esteemed partner and mentor, Sean Moran. And he is going to kick us off today, setting the stage on the IRA.
The speaker page kind of is just the tip of the iceberg with respect to V&E. We have just an incredibly deep kind of team that many of you kind of that are attending kind of have your regular contact with, David Peck and Todd Way and Ryan Carney, Mary Alexander, Ben Livney, Sarah McIntosh, Jeff Slusher, Hugh Ray, just to throw out some names. Those folks on a day-to-day basis with all of us are kind of, the front line with respect to IRA. So feel free to kind of, touch base with kind of your old counsel and colleague. On the corporate side, I really feel like I need to just call out a few folks that are just experts in so many areas. So it's a special kind of call out for kind of a lot of the things we'll talk about today kind of relate to the, assets that these folks kind of have just spent careers on. Alan Alexander, Daniel Patterson, Stephanie Coco, Michael Joyce, Aaron Prince, Matt Falcone, Doug Bland, Sarah Morgan. Super deep. This firm is an energy firm, and we have been living IRA for this last year. And this kind of collective team has really kind of brought to bear kind of just terrific kind of advice and direction with respect to where we think things are and where we think things are going, The audience, I see that the attendees number is continuing to rise. It's really kind of just terrific, and it's kind of reflective of kind of the energy transition that we've been all talking about and carbon reduction. On the list of folks that are attending are some giant companies, some small companies, lots in between. And it's really broad involvement, just in terms of the verticals that, we refer to these as asset verticals kind of in the energy transition space. And a lot of the companies are kind of focused on one thing or another. Like Lauren said, on some of this stuff, we will cover it today to an extent, but please feel free, to reach out to us to kind of bring up the particular issues that are either kind of viewed as an opportunity for you kind of, or an issue that needs to be resolved. That's where this is really kind of where we've been able to play an important role. And
every question makes us smarter. So we're really serious about that.
Yeah. Fact patterns are awesome. We even have somebody, I've just been having just joking about this a moment ago, folks from Treasury on the phone, and just to say it, you guys are doing a great job. We do not envy, all of the guidance that you have to provide on this giant piece of legislation. So great job. There's some stuff we'd like to help you with, kind of just as things evolve. But thank you for all the efforts. We tried to explain the words in the legislation, right? That's the background. It was fresh, kind of just in the books, and we were trying to kind of convey to you all what we thought, how to interpret it, what it said, kind of some of the nitty gritty, like Lauren said, some of just the general concepts that were out there. And we've continued, this is kind of just amazing, right? And this is the Treasury work. We've continued to supplement kind of that indication of what IRA was all about, all of the legislation. And we've actually published 17 and after today, 18 alerts with respect to kind of the guidance, pretty much the guidance and the regulations that have come in since IRA. And we've got some important pieces of guidance kind of coming up. So stay tuned. It's on our website. And again, consult us if you're having trouble with anything in particular. Many of you, I could spend an entire kind of session on this page. And many of you have heard me kind of go through this. I won't do it again today, but it is the outline for what's in IRA, and it's a bit of something for everybody. Next slide, please. And this is the actual detail. This could be my favorite slide here, of kind of what was in IRA and all of the tax code provisions that were impacted with this legislation. And it's just amazing, right? Just in terms of how many things it touched. And one thing that we've said throughout to you all is that this piece of legislation is not just contained in the tax code. A lot of these provisions we have kind of grown up with understanding kind of wind facilities and solar facilities, and Congress not being necessarily so kind of cutting edge or inventing kind of new kind of approaches to things, kind of borrowed a lot of what we have spent a lot of time with in these other provisions. So we were comfortable with a lot of these things that were enacted and what we thought they were trying to say, even though it was on a different type of asset. But what this legislation did, as many of you know, and like Lauren had said about Alex, it reached into other parts of law that you need to kind of have some familiarity with to be able to make sense of some of these provisions. So it just fascinating, right? That the tax code now brings into it Davis-Bacon and prevailing wage. It brings in, and now it's got its own set of regs. It brings in kind of transportation rules with respect to domestic content, lots of real estate understanding with respect to energy community, that type of thing. The one thing, go to your local congressman here, that we still need to fix is transmission. That is still kind of out there as something that all of these kind of great ideas with respect to kind of creating kind of power is how do we get it to the load centers? Where it's windy and sunny, how do we get that to the load centers? Still needs to be resolved. Storage can kind of help with that, but it really needs to scale. Transmission could play a vital role as well. One piece I did not hit so far is the credit monetization. Next slide. This is like there's interesting things in this legislation, but the fact that we can monetize these credits in a way that's not the old-fashioned way of trying to find somebody with a large tax capacity to bring into kind of an ownership arrangement with respect to the asset. Next slide, please. So that's kind of down the bottom there, the traditional tax equity. We normally had to bring in somebody to kind of participate in one way or another and take advantage of the traditional tax equities tax return to use to take advantage of the credits and create kind of cash flow in a transaction, or at least a return. As you all probably know, the transferability and direct pay provisions in the legislation are kind of an amazing step that Congress took to kind of bring in kind of just a broad swath of investors really into this space. We're seeing an incredible amount of transferability activity helping folks with concepts, term sheets, documents, closed transactions kind of thing, just moving credits from someone that doesn't need them, doesn't want them, kind of, but it's freed up kind of the market. And we've seen it in direct pay as well. We'll touch upon this a little with carbon capture and hydrogen and those types of things for 45X, the U.S. manufacturing provision, and tax exempts. But that is something that is, in a way, it feels like it's a little behind the transferability and developing. So I think I'll transfer it over to you, Heather, kind of, and then just chime back in along the way.
Okay, next slide, please. So as Sean was saying, the IRA created just a new access for folks to be able to directly sell credits, to transfer credits without having to be an equity investor. And that ability to transfer applies to essentially all US taxpayers. And starting this taxable year, taxpayers who are generating credits in clean energy products that are eligible for most ITC and most Section 45 PTC, as well as alternative fuel vehicle refueling property credits, are able to sell directly all or any portion of an eligible credit that they are generating. And that portion of credit is going to include any bonus credits, any adders. It's going to be a strip of the total available credit. So if there is a 6% ITC that's been bumped up to a 30% ITC because a project has qualified for prevailing wage, and then they include an additional bonus adder, like Lauren is going to, and I will discuss later, you can transfer a strip of that piece.
And we should mention that was a clarification that was made in the proposed regulations that came out just a little bit ago. We got proposed regs on transferability and direct pay, as well as information on registration and filing. The comment period for those regulations has closed, but Treasury will likely still accept comments if folks have them. And then we're awaiting final regulations, which will make any changes to the proposed regs. But one of the key items is what Heather is describing, that you can transfer a portion of credit, but it's really a vertical slice. You cannot slice off just the bonus credit. You can only do a proportion of the overall credit.
Right. And you can transfer that portion to multiple transferees, but there's only availability of one transfer. So a transferee can't then enter into an additional transfer or sale. And in order to make that transfer, taxpayers have to pre-register each eligible credit property through a registration system that's still being set up. And they are going to need to register and then ultimately make a separate transfer election for each year that the credit is available and for each eligible credit property. For example, for each wind turbine that is generating PTCs, if you're transferring PTCs from a wind project. However, taxpayers may make a single transfer election for ITCs, wrapping up the energy property that is integrated in a single energy project.
Once we bring down I'm sorry, Lauren, once we bring down kind of the website with respect to the registration with each turbine kind of around the country, I think it's going to have to be revised slightly so this is a little more efficient. Sorry, Lauren, go ahead.
No, I was going to hit the same topic. We know that Treasury is actively working on the registration portal for both direct pay and transferability. They've held working sessions with tax practitioners and other interested parties to get some comments and feedback. From what we have heard, the direct pay portal is a little bit farther along than the transfer portal, but all indications are those will hopefully be open before the end of the year.
And it comes up in documentation, and we've gotten this question kind of a bunch of times. Should we wait for the registration kind of to get sorted out to kind of engage in the transfers? And our view from the outset with respect to kind of a lot of the pieces of the transfer provisions, you don't have to wait, right? You can document kind of around this type of thing with covenants that the registrations will be made and all that type of thing timely, so you can build in the mechanics in your transfer documentation. We'll hit on this in a couple of pages.
And just one last piece, there is an opportunity for syndicators or brokers to facilitate credit transfers as long as they are not taking ownership of the credit. So they are not running afoul of that limit on the number of transfers that can apply to a given credit. Next slide, please. So as Sean was saying, this registration portal is important to have up and running because in order to transfer credits that are generated in this calendar year, now that we are in 2023 and credits are eligible to transfer, you can enter into contracts for that transfer in advance, but the payments are going to need to be made in cash and during a limited time period. Cash payments for transfers need to be made in the year that the credit is generated or prior to the filing of the return that reflects the transferred credit. There is generally tax-free treatment to both the buyer and seller of a credit. Income that is in theory received by the buyer from a transfer will be treated as tax-exempt income. And if a seller has paid less than the full purchase price amount for a credit, there's guidance that says they won't be required to show income on the difference between the bargain purchase price that they paid and the amount of credit that they're reflecting on a return.
And just to jump in here for a second, Heather, sorry, we're going to probably say the same thing, Lauren, right? The cash here is a real inconvenience, right? Just in terms of the timing of the cash, right? For a 10-year PTC deal, you can contract to kind of buy the credits over the 10 years, but you cannot pay for them. So it almost calls, we'll have two transactions. We'll have the credit transfer and then maybe a debt financing to provide some liquidity to the sponsor. Go ahead, Lauren.
Yeah, and just to pile on to what Heather was describing, one of the open questions is how to treat other payments related to the transaction, but which aren't actually the purchase price. So to what extent you can deduct commitment fees or legal expenses, or whether those might be income to other parties. That is an area that the regulations kind of punted on. I think most tax counsel could give you advice on that question, but I do expect that might be something we see further guidance on in the final regs.
Agreed. And a transferee is able to consider or reflect a credit that it is purchasing or intends to purchase when calculating its estimated tax payments. So for credits that are being purchased under agreements that are entered into this year but that haven't yet been registered, transferees can nonetheless reflect the anticipated impact of the credit at their estimated tax payments.
And just to pause on that one too, sorry to keep on jumping in, but it's a massive difference from kind of direct pay. Direct pay, you have to wait until the filing of the return, right? So let's say you're on extension, so it's the end of 2024. And by the time the government kind of actually cuts a check, you could be in 2025. So what Heather is pointing out with the transfer provisions, you can have a timely movement of cash and benefit on your estimated tax payments. It's a big time difference that needs to be thought through with respect to just present valuing kind of. If you have a discount on the transfer as opposed to, full freight, full dollar on direct pay, kind of thinking about whether the transfer kind of is just beneficial or not. It's just kind of a math equation.
And we're seeing with the third quarter or estimated tax period coming to a close for many taxpayers, we're seeing a lot of transactions looking to close this week. And we'll expect a whole new round of transactions to start up thereafter for folks looking to put aside tax credits that they purchased against their estimated for fourth quarter.
And so we said earlier that generally all U.S. taxpayers can transfer eligible credits for a partnership. That means that the partnership itself would be the transferee, a transferor of tax credits, as opposed to the individual partners in the partnership. And a partnership can transfer all or any portion of a credit that would otherwise be allocated to its members. And the tax exempt income received as a result of that sale would be allocated to the members in the same proportion that the credit otherwise would have been. So there's the true up there, a good matching between the tax credit that's being transferred by a partnership at the direction of a partner and the allocation of tax exempt income. And that was a clarification from the regs. I think prior to the proposed regs, people were speculating how it might work for a partnership that was making a transfer and then looking to clean up allocations in a way that accurately reflected the economics between partners. And the cash received in connection with the transfer is able to be utilized by the partnership or distributed to the partners in any manner, however the partners choose. It does not have to follow the tax exempt income or the otherwise allocated portion of credit had it not been transferred. When we talk about eligible credit, we're not just talking about the specific ITC or PTC that is able to be transferred. We're also looking at the amount of credit available for transfer. And for a partnership, there are passive loss rules under Section 469 that would apply to the transferee, so the purchaser of credits, which limits the ability of individuals to invest in a partnership and purchase credits. And on the transferring side, at-risk rules in Section 49 may apply to limit the amount of available tax credit, in particular an ITC, an investment tax credit for transfer. And there is also, as a follow-on to the rule, that only one transfer is allowed per credit amount. Taxpayers that have been passed an ITC through an inverted lease or a 45Q credit for disposal, utilization, or use of carbon dioxide are not able to then transfer credits.
And that is an area that we've seen taxpayers and other stakeholders kind of push back on and provide comment to Treasury. So that's another area that we're looking for potentially changing when the final regulations come out.
And just as one more piece, it is also not possible for a tax exempt entity to receive a transferred credit and then take a direct pay election. And there is some allocation of risk between the transferring parties. The recent prevailing wage and apprenticeship regulations confirmed and clarified that a transferor is going to be responsible for the any increased credit that it has claimed as eligible. So again, if you are a taxpayer that is taking a 30% credit, ITC credit as a result of having met prevailing wage and apprenticeship requirements, then the transferor is on the hook for reflecting the qualification for that increase as opposed to the transferee. Although the transferee is on the hook for excessive credit transfer amounts, which can give rise to a 20% additional tax that can be avoided by showing reasonable cause for reflecting the tax credit amounts on their filing. And some ways of showing reasonable cause include conducting diligence to confirm the availability and amount of eligible credits and obtaining third-party reports, reviewing transfer statements, and there are some requirements around providing documentation that can help transferors and transferees share information and will require a certain amount of diligence on the buy side.
The last two items, the recapture and the excessive credit, those, think about ITC type transactions. And it can be quite challenging, right? Just in terms of risk that could be taken on by a transferee when they buy the ITC, right? If the facility goes down or there's debt on the facility or something like that, that ends up as a transferee recapture. In other words, they have to repay the government kind of the credit amount. And what the regs did was they kind of split it, right? So they left that risk with the transferee, but then they put on the transferor, kind of the party that kind of essentially generated the credit, responsibility for kind of maybe if it transferred its interest or if it kind of blew the prevailing wage. So it's a heavy documentation point. And risk allocation, as Heather was saying, that just needs to be grappled with kind of early on in an ITC deal. And when you think about the excessive transfer, that's kind of markup. Think about markups, large markups where it's not supportable. Go ahead, Lauren. Sorry.
Yeah, no, I was gonna say let's switch to the next slide because this all dovetails together. As we're hitting on, there is an allocation of risk that needs to take place, and the way that happens is through a purchase and sale agreement, which looks very similar to an M&A purchase and sale agreement, except that there are very specific items and rules from the regs that we layer into those. So we need to make sure that a buyer has a required minimum documentation as part of its diligence to avoid that 20% penalty. We permit the parties to negotiate to allocate liability. And then there's also potential for tax credit insurance. That's another area where we're seeing lots of action and activity. Sarah Mitchell is one of our insurance experts at the firm, and we've been working hand in hand with her on a number of tax credit products for step-ups, as Sean mentions, but also 45X manufacturing, 48 biogas ITC, and labor qualification. And then we've also been working on 45Q credit qualification policies. So really, you name it, they'll insure it. And the last thing just to hit on this slide before we move along.
Next slide. So I think there we are. Sorry, go ahead.
Yeah, it's just the credit pricing. This is always the question we get is how much are the credits going to trade at? My joke is I'm a tax lawyer, so business people chime in here. But we certainly have a view, and the pricing is going to depend on a number of factors. It's not a one size fits all price. The type of credit makes a difference, the credit quality of the seller, whether there's bonus credits, the timing of the transaction, whether you have insurance, etc. All of those things play into credit pricing. Anywhere between 88 cents to 95 cents on the dollar is what we've seen.
And one thing just generally that I'm not sure we hit, Lauren, right, is thinking about transferability, before you need to transfer type of thing, kind of, once you're kind of in a transaction, whether you're the sponsor, a tax equity, or even, just somebody kind of that has an asset in mind. Think about the end game with respect to kind of taking advantage of these provisions and how you monetize the credits and what you need to do. You may call for early registration with respect to something so that you keep the opportunity at least available until the filing of your tax return. So lots of kind of planning here is appropriate with respect to all of this.
And let's move to direct pay. Next slide. One of the, I've seen a lot of questions pop up about the slides. The slides will be made available for anyone participating, so no need to furiously write notes or catch everything we say. So direct pay, this is kind of the flip side to transferability. This is the other monetization option, which was added by the IRA. It's basically available for any sort of applicable entities. We have them listed here. You can think tax exempts and those types of entities. However, there's a special rule that lets you do direct pay for all taxpayers for hydrogen, carbon capture, and the 45X advanced manufacturing production credit. One of the things that we've seen that Sean mentioned earlier is just the timing issues. Next slide, please. Because your direct payment is treated as a payment against tax. So the way it functionally works would be that you'd get a refund after you filed your tax return. And that can really slow down your ability to monetize the credit. So even though you might be eligible, it's possible that you would elect to do transferability instead for those 3 credits. We're also seeing that there's some interesting interactions between the base erosion alternative minimum tax and direct pay. So that's something to be mindful of and work with your tax accountants and counsel to understand how that might impact you. And that may push you to do a transfer instead of direct pay, even for 45Q, V, and X. One of the things that the proposed regulations provided is that if you want to do direct pay, unlike transferability, you have to do the whole thing. You can't just do a sliver of it or a percentage. So there is a little bit more of limitations there. But similar to transferability, if you're passed a credit through a lease or a 45Q credit through utilization, or as Heather mentioned, if you are sold the credit, you cannot elect for direct pay. Next slide. So this is an area that we've spent a lot of time on, kind of surprisingly so, and it came out of the regulations or became more apparent once the regulations came out, and that's potential issues with tax-exempt ownership, particularly if you have a partnership or a fund that's part taxable or part tax-exempt, or if you have any tax-exempt owners within your structure. What the proposed regs confirm is that for transferability, if you have that mixed ownership, you're fine. You can go ahead and sell the credits. But for direct pay, you can potentially lose the ability to do direct pay if you have that mixed ownership, even if you're a 100% owned partnership or a partnership that's 100% owned by tax exempt. There is an opportunity to structure around this if you can structure it such that it is a co-ownership arrangement instead of a partnership. But I think that's an open question as to what circumstances you might be able to do that successfully. So definitely something to talk to your tax counsel about. And the last thing to hit, just because it's an important one, the tax exempt use rules still apply. So again, if you have tax exempt entities in your ownership change, credits can potentially be lost. That's thankfully just limited to the ITC, does not hit other production-based tax credits typically. Next slide. All right, so now we're going to hit bonus credits. We're just going to focus on domestic content and energy community. There's also the low-income community bonus. We just didn't hit it here, but we have client alerts on that topic, and don't hesitate to reach out with questions. Next slide. All right, domestic content bonus. This is a 10% bonus credit newly enacted as part of the IRA. It's available on ITC and PTC credits. It's basically an additional kicker. So it's on top of the otherwise available credit. The domestic content bonus is just that. It's a bonus for using a certain minimum threshold of domestic content. And what the rules tell us is that you have to use 100% domestically sourced steel or iron. The regs clarify that it must be structural in nature, which is very helpful. And then for anything that's not structural steel or iron, there's a little bit more convoluted rules around manufactured products. But essentially, for manufactured products which you've identified as part of your project or facility, there's a minimum threshold that you have to hit as being domestically sourced that steps up over time. We do have preliminary guidance from Treasury on domestic content. It has received, I would say, a mixed reception from folks. One of the words you hear people use a lot when they talk about the domestic content guidance is that it's unworkable. That's not true for all assets or projects, and we are certainly seeing lots of projects that we think fall squarely within the domestic content guidance and would be eligible for the bonus. But as we'll kind of hit on a little bit later, there are some areas where the guidance would benefit from some improvements, and we're hopeful that we will see interim guidance from Treasury in the near term, and then final or proposed regulations coming out sometime next year. Next slide. So again, as mentioned, there's specific rules for manufactured products. The key takeaways here are that we have identified manufactured products. In order for those to be treated as domestically manufactured to hit your minimum threshold, all of the manufactured product components, which is another defined term, must also be manufactured in the US. However, the subcomponents of those manufactured product components do not. Another important item that came out of the recent guidance is that get rid of my poll, is that the costs that are relevant for determining that minimum threshold are the cost to the manufacturer of the manufactured product and manufactured product components. So it's not the taxpayer that's looking to take advantage of the domestic content bonus that has to provide the cost that you use to determine your threshold. You have to actually get it from the manufacturer. This obviously raises a lot of tension between developers and suppliers because suppliers or manufacturers naturally don't want to give up that information. It oftentimes is very sensitive or competitive, and there's really open kind of market changes going on determining how we're going to address that issue. And one of the things that we are really hoping will be addressed in forthcoming guidance.
So, I mean, this is a powerful credit, like Lauren said, and it really could use kind of just some help, just in terms of the math. And this provision is kind of the flip side. We're not really going to hit on it, I don't think, today, Lauren, right? Is the flip side of 45X. 45X is the provision that if you onshore your manufacturing activity and you sell kind of the product of that manufacturing facility, you're entitled to a fairly powerful credit on that side. Right, so there was inducing folks to onshore their activity and then sell it to kind of a sponsor and ultimately kind of the user, and kind of the flip side of this being the domestic content. But we've got kind of this impasse. We don't have the problems necessarily on the 45X. We just need to conclude that we've got manufacturing in the United States, but it's the math essentially in domestic content that's just causing us kind of just some difficulties, just put it that way.
Yeah, and we're going to try to hit 45X. We'll see if we make it. But I will say that's an area where we're waiting for guidance from Treasury and hope to get that this year. The next slide. I'm not going to spend any time on this slide, but again, you will all get this deck. And I think this is a great example of how the rules work in practice. Next slide. And similarly, this is just reproduced from the guidance that came out. This is one of the really useful things from the guidance in that it breaks down the manufactured products and manufactured product components that I referred to earlier. And you can see for some of them, it goes into incredible detail. The manufactured product components are really kind of small things. And then there's other items that are bigger, that might be more easy to establish. So spend some time with this slide. It's an interesting one, and one I certainly think is going to change and be expanded once the guidance comes out, or future guidance. Next slide. All right, Heather, can you hit energy community in 2.5 minutes?
All right, so another bonus adder for ITC and PTC projects is energy community. There are three types of energy communities: a brownfield site, statistical area, or coal closure. And the IRS issued a notice in April giving further detail on each of these categories. Generally, a project will be considered located in an energy community if 50% or more of its nameplate capacity is located in an energy community, or for projects without nameplate capacity, you look to the square footage for that 50%. And then for offshore projects, all nameplate capacity is attributed to the land-based power conditioning equipment generated by the project for transmission, distribution, or use, and that is closest to the point of interconnection. And importantly, the determination of whether a project is located in an energy community is made at the time that you are placed in service for ITC projects, or throughout the credit period for PTC facilities. But there is a safe harbor allowing for the energy community determination that is made at the time of beginning construction to apply throughout the PTC period, or to apply at the time that a project is placed in service for ITC, only for projects that begin construction after January 1st, 2023. So nothing that began construction earlier on. In those situations, there isn't that certainty about whether or not you're in an energy community based on the information available at the time. Next slide.
And that's probably the hardest issue. The energy community guidance that came out is pretty great, and it provides a really good framework for getting comfortable with energy community and makes that bonus credit pretty financeable. But that last piece that Heather touched on is the issue, if there is one, is just making sure, particularly for a PTC facility, that you're going to continue to be eligible for the bonus credit for the full life of the credit. And if you began construction prior to this year, you're not eligible for that safe harbor. So we're spending some time there.
So for a brownfield site, the definition is under CERCLA, generally real property, the expansion, development, or reuse of which may be complicated by the presence or potential presence of a hazardous substance, pollutant, or contaminant. And you can be recognized as a brownfield site if the site has previously been assessed as meeting the definition of the brownfield site under CERCLA, section 9601. And you can also be recognized as a brownfield site if a phase 2 environmental site assessment, or for smaller projects with a nameplate capacity not more than 5 megawatts of phase 1 environmental site assessment confirms the presence of hazardous substance or pollutants on the site. And the notice follows the EPA's state brownfields and voluntary response search programs to help taxpayers discover where they're looking at a brownfield site. But to the extent that the area is not covered, you may be able to get a determination letter from the state to establish project location and an energy community for brownfield site purposes.
And this is an area that we work with our environmental colleagues on quite a bit, making sure that they're working with us and we're all getting comfortable. Given time, let's skip forward to the labor requirements. I know everyone's anxious to hear about that. So Alex, will you take it away, please?
Yeah, if we could just go right to slide 25. There we go. So I think a lot of people who have been working in this space are already familiar with the basics of this because they've been living with it for the past year, trying to figure out how to implement these requirements. But just for some background for some people who maybe not know, is what a prevailing wage is. It's something that's determined by the Department of Labor it was previously used for federally funded construction projects. And so it's a wage that applies into a particular county to a particular job type, like electrician or general laborer. And it's going to be different depending on where you are in the country and what kind of job someone's doing. Apprentices are someone who's training in a particular field in one of these job categories, but they come from qualified apprenticeship programs. They have to be registered with either the state apprenticeship agency or with the Department of Labor. So these aren't necessarily just going to be people that you're training at your company. And so implementing these there's both the interpretation of the regulations that we're working through, but there's also a lot of interesting practical concerns, both in contracting and in the implementing the day-to-day aspects of this that we've been working with clients on. And I think that's really, I think, where the rubber meets the road and where the most interesting questions come up. A few weeks ago, we received proposed regulations about these rules, and they answered some questions, left some to be answered, created some new ones that we're still working through. But they have overall been helpful in clarifying some of the things that we're working on. And we'll have a whole presentation on that coming up here before too long. So keep an eye out for that. We aren't going to be able to get into the details of all of the things in the new proposed regulations here. But if we could go to the next slide. So for the prevailing wage requirements, these include both minimum wages and fringe benefits. So it includes things like life insurance, health insurance, contributions you make to 401ks, pensions, that sort of thing. But you can just meet these with cash. There are often just some payroll tax benefits to doing it other ways. One of the things that we learned in the new proposed regulations is that when you determine what the applicable prevailing wage is at the time the construction, alteration, or repair of the facility begins. Now, that is contrary to some guidance that we got from the Department of Labor previously, who had published something saying that it was for the taxpayers, contractors, and subcontractors, it was going to be the time at which the contract was entered into. So if you had previously been relying on that, you might think of updating your contracts now to reflect that these might have to change as new wage determinations are issued. And you also have to think about when again, from the proposed regulations, if the work is going to be expanded from the original contract, or if the time period to complete that work is going to be longer than originally obligated, because then you have to update the prevailing wage again. Under what the DOL had told us previously, that had been locked in. And so now we have to think about changing these, and whether your contracts with your contractors or their contracts with subcontractors allow that updating and make sure that all of you're covered there. Next slide. And so then the other aspect is apprenticeship requirements. The new proposed regulations divide these into three separate requirements. One is the labor hours requirement. It's using a certain percentage of the work that's being done on the project. So labor hours, not number of people, that has to be performed by apprentices. So, and the number is based on when construction of the facility began. So you can see those numbers there. It goes from 10 to 12.5 to 15, depending on which year in the construction started. There's also the ratio requirement. The ratio requirement is something that refers to the apprentice to journey worker ratio. It's the minimum number of journey workers you can have on site for an apprentice in a given day. And so you talk to your apprenticeship program that you're working with, and they might say it's 1-to-1. That means you can have one apprentice for one journey worker. Or if it's 1-to-5, that means you need to have 5 journey workers for every apprentice. And that's to ensure that the apprentices are receiving the proper training. I can tell you as a practical matter, in some of these fields, that you might just be adding on apprentices to your normal staff, because you need the people who are trained in a specialized area to really be doing some of this work. And you can't rely on apprentices to make certain commissioning determinations or things like that. And so these are sometimes just an added cost with these apprentices.
And Alex, the ratio requirement, that's not set in the IRA or the regs, right? That's something
Right.
that we defer to the apprentice program. So
Right.
just have to do some legwork to figure out what that might be.
Yeah. And so the apprenticeship program, when they register, will get their apprenticeship to journey worker ratio approved by the state agency, by the Department of Labor, and they will be able to tell you what that is for different types of work being done as you hire, or I guess engage with the apprenticeship program. And then you have the participation.
Alex, maybe hit on kind of, large GCs kind of get it because they've been living with this for Davis-Bacon, at least on the prevailing wage side of things. But what you're seeing with kind of GCs, smaller GCs, kind of the subcontractors, and kind of just the anxiety out there and the ability to comply.
Yeah, so that actually, ties really well into the participation requirement, because it's saying that every contractor has to use at least one if they have 4 or more individuals performing construction, alteration, or repair. And so even if you have a big GC who has done government contracts before, kind of understands some of the requirements that come into all of these issues, their subs may be less sophisticated. If you have a smaller project that has someone who's never worked in this kind of space before, they may not know how to do any of this, but they still have to make these requests to get apprentices and comply with the prevailing wage requirements. And you have to monitor what they're doing, because it ultimately comes back to you as the taxpayer to ensure that all of these requirements are being followed. And there's, I guess, a third bucket of big requirement of kind of both in addition to the prevailing wage and apprenticeship requirements, that is the record keeping requirement showing that you complied with the prevailing wage and apprenticeship requirements. So you're going to have to make sure that you're getting the records necessary to show compliance from all of those people, no matter how far down the subcontracting line you go.
And that's an area that Alex is spending a lot of time on, is working with clients and counterparties to develop the records so that when we're executing a contract, we can say every quarter, this is exactly the form of what you're going to provide us.
And we got
a lot of negotiation. Sorry, Alex.
And we got some guidance in the new proposed regulations about exactly what needs to be kept as far as records go. And that was very helpful so that we know what we need to do to demonstrate compliance. And now not everyone's going to be happy about providing those things. But, we have to work through it to actually get the information we need. And so negotiating that has kind of been a sticking point, but it is something we need. And I can go to the next slide.
Yeah, and I'm going to jump in on you, Alex. So this will just be a teaser for all the prevailing wage and apprenticeship requirements. We'll be sending out notice of that next session. Corinne, can I turn it over to you to give us a quick environmental law update, and then we'll get back to IRA.
Yeah, absolutely. So next slide, please. If you could keep going forward to, I think
it's slide 40.
Yes.
All the way to slide 40.
So we've talked a lot about some of the carrots that are in the IRA, but there's also some sticks. And if you're in the oil and gas sector, you are already aware of the methane fee that has been put in by the IRA. And we're not going to have time to get into detail now about how that's being calculated and some of the kind of complexities there, but that's certainly something we've been talking to a lot of clients about. One thing I just wanted to flag that's incredibly timely right now is revisions to the way that greenhouse gas reporting is being done, which will also impact how this fee is being calculated. So under next slide, please. The IRA also required EPA to revise its regulations for mandatory greenhouse gas reporting for the oil and gas sector. They want to make this more empirical and make sure that the reporting is more accurate than it has been in the past. And so EPA has put out a proposed rule for how it's going to consider doing that. Next slide, please. So as I said, this is important for two reasons. The first is how burdensome those reporting requirements are going to be going forward. EPA has proposed to cover a lot of new types of equipment. And in addition to just the burdens of the reporting itself, the way that they're calculating things under these new revisions will impact the way that they determine what the appropriate methane fee is for everyone to be paying. Comments are due on that proposal on October 2nd. So there's still a little bit, but not much time to review and submit comments to the agency about their proposed approach here.
Awesome. Thanks for that update. Important to keep that in mind. All right, let's skip back to slide 31, please. So for folks that are going to stick around for the last 15 minutes, this will be extra credit. We're going to go over some of the other credits that are within the IRA and provide an update. All right, so first, 45Q, this is the carbon capture and sequestration credit. The main change in IRA is that it extended it, it gave you more credit, and it made it a little bit easier to qualify. So it lowered the capture requirements, increased the credit, and extended for construction beginning before 2033. Importantly, the labor requirements that Alex touched on also apply for 45Q. So in order to get that higher credit rate, you do need to satisfy them. Also importantly, direct pay and transferability apply. And again, this is one of those credits that regardless of the type of taxpayer you are, you can elect for direct pay for 5 years for the 45Q credit.
And just to say it, right, if you look at kind of the amount of the credits, they're huge, kind of, right? They've turned facility or transactions, potential transactions that were marginal or maybe really didn't foot into something that, you know, is worth at least seriously considering given kind of the magnitude of the benefit. And if you look at the direct air capture, that one is just even twice as large, 3 times as large as kind of some of the others. So it's lots of activity in carbon capture.
Right. And I think Sean and I have been surprised to see more action in direct air capture than before, just given, as you mentioned, the economics actually make sense. So those deals are starting to happen.
And the labor requirements were a little tricky here, kind of on the carbon capture and kind of the emission facility and that type of thing. So proceed carefully and bring Alex in early.
Yes. Yes.
On this type of thing.
All right, next slide. Sean, I think this one's your favorite. This is the hydrogen credit under Section 45V. This is a brand new IRA credit. Very powerful. As with 45Q, this credit makes projects that wouldn't be financeable look very attractive. The main thing I want to just touch on here, because we could spend hours on hydrogen, is that we do not have the guidance out yet. So we do not know how to officially determine the amount of credit that you might be eligible for, because that credit is based off of your greenhouse gas emission rate. And we really need the regulations from Treasury to give us definitive guidance on how to do that.
We could start a pool. We could start a pool on that one, right? It was supposed to be a year from enactment of IRA. You know, we might see it in October. We might see it hopefully by the end of the year at worst. The one thing I would add here is not only do we need the guidance with respect to kind of you know, how to think about some things, but the life cycle analysis and Argonne and GREET modeling. We've spent an extraordinary amount of time kind of understanding that and where kind of things in the model you need to understand, and how, you know, you might be able to kind of tweak kind of either feedstock or methodology or measurement of kind of carbon emissions to kind of work your way into the highest credit. This is a tiered credit. So the challenge is, how do you get into the highest bracket? Once you're there, the numbers are kind of, you know, quite large and kind of have brought facilities from 5 or 10 years down the road to kind of being seriously kind of explored, you know, actively now.
Right. And this is an area that I think I'm happy to see Treasury and the IRS take more time on the regulations, because it's tough. There's a lot of really novel issues here. Things that we expect to be covered in the regulations include additionality requirements, location requirements, time matching, and as I think Sean alluded to, the extent to which you can use market-based mechanisms to green up your hydrogen. So can you use a virtual PPA or REX, or the overall green mix of the grid to be taken into account when you're determining your GHG for your hydrogen? Those are all really key issues that Treasury is going to hopefully be touching on. And depending on what side of the aisle you sit on, or your view on these things, there will inevitably be some people that are not happy with the regs. So this is an area in particular that I do not envy Treasury on.
And one last thing I should say, right? We were doing hydrogen deals before we realized that they were cool, kind of thing, kind of with respect to kind of ammonia facilities. So we've been living kind of with hydrogen for a long time, and just understanding kind of the role it plays kind of in the market, and the opportunity that now exists with this credit.
Yeah, absolutely. Next slide. All right, 45X. I said I hoped we would get it, and we made it to 45X. This is the flip side of the domestic content bonus that Sean mentioned. This is a credit for manufacturers who do domestic manufacturing. So if you buy enough manufactured products that are domestic and put them in your project or facility, you could potentially be eligible for the domestic content bonus. Here under 45X, the seller of those domestic components, or the manufacturer, may be eligible for a credit as well. And this is an area where you can stack credits. You get them on both sides of the supply chain, which is great. And we're seeing this work in real time. We're seeing announcements all the time about new facilities being opened. Just this week, I saw a news piece about a solar manufacturer moving a facility to the US, and there's lots more that we're aware of in the works. So very exciting. We are still waiting for guidance for 45X, but the domestic content guidance help us a bit, as does some of our background on what it means to manufacture in the US generally. As basics, it's a per component. Each component that rolls off the manufacturing floor and is sold to an unrelated person, or a related person for which there's some special rules, you get a credit. We're also seeing a fair bit of financing around 45X. So this is a credit that's eligible for direct pay and transferability, but due to timing reasons, in order to set up a US manufacturing facility, you need a lot of capital. So folks are looking to borrow against future 45X, and we're starting to see that kick off in the market.
And one thing just to throw in here, just because it's fascinating, right? This is kind of manufacturing facilities, like the stuff that you would think about, kind of bringing it onshore, solar panels and inverters and stuff like that. It's kind of just something that's out there in IRA, just to motivate bringing kind of the activity into the United States.
Yeah, thanks. Next slide. So 48C is the Advanced Energy Project Credit. This is a version of the 45X credit, in that it's generally available for setting up or establishing a manufacturing or similar facility in the US. And if you're doing this, you have to pick between one or the other. Either you get the 45X production-based US manufacturing credit, or the 48C energy project credit, which is more of an investment tax-based credit. This is one that you have to apply for. It's one of the few credits in the tax code that you have to actually apply to the government and then receive an allocation in order to claim it. There was an initial round of allocation of this credit that was opened up. It has since closed. We should know by spring next year how much of that credit has been eaten up by taxpayers that met that first date, and then have a sense of whether there'll be future allocation rounds opened up for taxpayers to apply to. Next slide. All right, I think this is the last topic we're going to hit on today. renewable natural gas. And this is an area that has been a lot more active and where I've spent a lot more of my time than I expected to, frankly, when we were sitting here a year ago. Two of the credits that I just want to call out in particular that are brand new from IRA are the ITC for biogas property and the 45Z clean fuel production credit. Again, these are brand new IRA credits, but they're very powerful. We're seeing a lot of deals in this space. We're seeing tax credit transfer deals on ITC biogas. And then we're seeing lots of financing deals and JVs even looking to take advantage of 45Z. And again, this
just
is
one thing on the, I'm sorry,
Yeah.
one thing on the Z item, right? We're hoping for some guidance before 2025, right, with respect to that provision, right? Because there's facilities being financed now and trying to kind of make sure that, or try to measure the amount of the credit that may be available based on projections of operations. But we don't have kind of guidance with respect to kind of carbon intensity and what the actual credit math may turn out to be. So hopefully we get some of that sooner rather than later.
Yeah, let's skip to 38. We talk a little bit about that on that slide. And importantly, you can take the 45Z and the 48. So there can get kind of double benefit for projects that happen to meet both requirements. And surprisingly, we're seeing that the 45Z credit, at least based off of current estimates, can be more powerful than the 48 ITC. As Sean mentioned, that is all subject to guidance. There's not a ton of certainty around how the emission rates for certain facilities or types of clean fuel is going to be determined. We have some guesses. We can look at LCFS or we can look at CARB as giving us indication of what the right number are, but those metrics are not similar. And we don't have a sense of which one Treasury is going to pick, or if it's just going to come up with its own metric or determination of emission rates. So some big open questions here, though folks are still doing deals and you can make some conservative assumptions and underwrite a conservative credit amount. Another plug for Alex, there are labor requirements on 45Z. They're a little different than the other credits. Even if you've begun construction, it seems that you have to continue to comply with them during the credit period or for periods after 2024. Probably screwed that up, so Alex will correct it when he does his full session. But that's a nuance to be aware of and be mindful.
I mean, does it make sense, Alex, just to put you on the spot there, can you just speak about alterations? Because there's kind of a confusion there with respect to kind of prevailing wage and requirements and apprentices and stuff like that. Just at a high level.
Sorry, you're asking me to speak about what?
Just in terms of kind of what are alterations and kind of the extent
I
of
see,
the labor requirements.
I heard alterations and alterations. Yeah. So when you do alterations and repair, that's covered work and that's to be distinguished from maintenance. So your routine maintenance is not covered. That's replacing things like light bulbs, things that you would expect to fail. And so you do things that you can schedule for. But things that are not anticipated to fail, that you have to come in and fix, like warranty work, that is covered, and you need to bring in now both apprentices to do that work and pay prevailing wages for that. And frankly, there's some real challenges to that. Like if you have something go down that makes your facility inoperable, how do you get an apprentice lined up in time to do that? And so those are some real challenges that you have with alteration and repair that need to be addressed and that you need to find practical solutions to.
And I've even heard some disagreement as to what extent you need to use apprentices for alteration and repair after an asset is placed in service, which would apply for 45Z up on the screen. Hopefully I'm not giving away too much here, but I think if you look at the statute, we would suggest that you do not need to use apprentices for alteration or repair, but the regulations really kind of muddy the waters a little bit and make it unclear as to whether that's the case. Alex, hopefully I didn't misspeak.
No, I think that's exactly right, is that we previously would have said that you didn't need to use apprentices where it didn't make sense to use apprentices, but it's not so clear anymore. And that's actually something we'd hope would get clarified as the rule becomes final.
So with that, I think we did it with a few minutes to spare. I have sufficiently pushed people along and skipped slides. But thank you everyone for joining. Thank you to my colleagues. This has been great. I'll say it again, please don't hesitate to reach out. We have all of your questions in the chat and we will do our best to address them. And looking forward to seeing you all on Alex's Prevailing Wage and Apprenticeship program, looking for that hopefully next month. And as further developments come out, we will be putting out more alerts and happy to engage. Thank you, everyone. Bye-bye.